As of the market close on June 16, 2026, at 4 p.m. Eastern Time, Navitas Semiconductor trades at an exact price of $22.09 per share, marking a significant intraday decline of 6.91%. On the surface, this sharp drop looks like a typical high-beta semiconductor sell-off, a routine pullback for a stock that has experienced volatile swings over the past several months. But if you peer past the daily price tape, something much more complex is happening under the hood. The real story isn't just about a bad trading session or a temporary drop in buying volume. It centers on a massive strategic pivot, where the company is trying to aggressively transform its underlying architecture to capture high-power data center demands, all while issuing millions of new shares that are actively diluting current investors. The market is caught in a fascinating tug-of-war between a highly visible partnership with major hardware ecosystems and the harsh reality of immediate diluting equity programs. When people look at Navitas Semiconductor today, the general expectation is that this company is a clear, uninhibited winner in the infrastructure build-out. It has been showcased next to some of the biggest names in technology, causing retail and institutional traders to pile into the stock, hoping to catch the next great supplier wave. But the reality is that Navitas is burning substantial cash to fund this massive industrial transition, forcing it to lean heavily on the public markets. Just a couple of weeks ago, management announced a massive $500 million at-the-market equity program alongside the immediate resignation of a long-standing board director. To make matters even more complicated for retail investors tracking the stock on their Robinhood app or trading through traditional platforms like Fidelity, the company just issued over 3.28 million shares to satisfy legacy earnout obligations from its original business combination. When you balance a tiny current revenue base against a $500 million dilution threat, the investor narrative changes from a simple hardware bet into a high-stakes financial balancing act. Let us break down the recent price action and technical trading dynamics that define this equity. This latest downward swing to $22.09 follows a period of extreme volatility. Earlier in June, the stock experienced a dramatic intraday spike of nearly 19% when investors celebrated its integration into advanced high-power system architectures for megawatt-scale server environments. Yet almost immediately after that euphoria peak, the stock tumbled as the reality of the share issuances began to settle in. Institutional clearinghouses and individual brokerages saw a massive surge in trading volume as the stock struggled to absorb these new shares. The broader semiconductor sector has also been dealing with macro pressures, including shifting interest rate expectations and fluctuating options implied volatility. When the chip sector encounters a volatile week, small-cap components like Navitas tend to amplify those movements. Traders utilizing advanced interactive brokers platform tools notice that the implied volatility on Navitas options has surged, indicating that the market is pricing in wider and more aggressive price bands as we move closer to the next earnings report. If you are tracking your overall portfolio on an automated service like Schwab Intelligent Portfolios or managing an individual brokerage account, you need to look at how institutional fund managers are behaving here. Mutual funds and exchange-traded funds hold roughly 18% of the outstanding shares, while other institutional backers control over 31%. This means half the company is still held by public retail investors who are susceptible to rapid sentiment shifts. When news hits that a company has completed all its contingent earnout obligations, bringing total legacy issuances to nearly 10 million shares, institutional risk desks immediately recalculate their valuation models. They look at the forward price-to-sales multiple, which is stretched to astronomical levels relative to traditional chip companies. The active $500 million equity program acts as a continuous ceiling on the stock price, because every time the equity attempts a sustained rally, the potential for at-the-market issuance looms large, absorbing available buy-side liquidity. Now let us examine exactly what this business does and how its technology works. Navitas Semiconductor specializes in next-generation power electronics, specifically focusing on gallium nitride and silicon carbide materials. Traditional silicon chips have physical limitations when it comes to speed, thermal efficiency, and voltage management. Gallium nitride technology allows power systems to operate at much higher switching frequencies, while drastically reducing the physical size of the components. This makes it highly attractive for everything from mobile fast chargers to complex power delivery systems in electric vehicles and consumer tech. On the other hand, their silicon carbide products are designed for ultra-high voltage industrial environments, renewable energy grids, and large-scale infrastructure. The core value proposition is clear. By replacing old silicon with these advanced materials, systems become smaller, lighter, cooler, and far more efficient. The company's monetization model relies on designing these proprietary power integrated circuits and selling them directly to original equipment manufacturers and Tier 1 suppliers across the globe. However, historical performance metrics show how difficult it is to scale this business profitably. In their first quarter earnings report, Navitas posted revenue of $8.6 million, which actually beat low consensus forecasts by about 5% and showed an 18% sequential increase. But look at the bottom line. The company reported an earnings per share loss of 15 cents, missing wider expectations, and logged an overall net loss of $33.8 million for the quarter. Compare an $8 million quarterly revenue run rate against a multi-billion-dollar market capitalization, and you can see why conservative analysts remain highly skeptical. The company's legacy business in lower-margin consumer electronics has faced steep macro headwinds and a cyclical slowdown, forcing management to initiate a rapid, aggressive pivot toward high-power markets. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio. It is vital to see how regular investors are positioning themselves amidst this massive corporate transition. Looking ahead, the future outlook for Navitas depends entirely on whether reality can finally catch up to the massive market expectations. There are two distinct, divergent pathways for this stock moving forward. The highly bullish scenario hinges on their recent product developments and high-profile collaborations. Management recently introduced an isolated through-hole package for their silicon carbide devices, which enables direct cooled thermal management. This is a crucial feature for the high-density power boards required by modern computing systems. If their technology becomes an indispensable standard for high-voltage direct current infrastructure, the current revenue base could scale exponentially over the next 2 to 3 years. Under this scenario, the massive capital raised through their equity programs will be viewed as a necessary visionary investment that funded critical manufacturing scale and engineering talent. Conversely, the bearish scenario is rooted in execution risk and severe financial friction. If the adoption of advanced power materials by data center operators happens at a slower pace than the market anticipates, Navitas will continue to burn through cash without achieving the scale required to achieve profitability. Meanwhile, the continuous threat of dilution from the $500 million at-the-market program will keep downward pressure on the share price, eroding investor confidence. If quarterly revenues remain in the single or low double-digit millions while net losses remain elevated, institutional backers may lose patience and rotate their capital into more established cash flow positive semiconductor firms. Furthermore, any sudden changes in corporate leadership or other unexpected board resignations would likely exacerbate fears regarding the internal stability of the company during this pivot. When you evaluate Navitas Semiconductor today, you are looking at a textbook example of the tension between market narrative and financial reality. The expectation is a high-growth tech darling riding the coattails of the modern data center expansion. The reality is a tiny, pre-profit component designer dealing with massive structural changes, corporate governance shifts, and significant equity dilution. Navitas has the underlying technology to play a critical role in the future of energy management, but the financial runway to get there is costing current shareholders a premium. As the market digests the completion of legacy earnout obligations and watches the deployment of the new equity program, investors must decide if the long-term structural upside justifies enduring the intense short-term volatility. Maintaining a disciplined view of these fundamental dynamics is the only way to navigate a stock that moves this fast. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.